The Nasdaq had its worst day of 2023 yesterday. We're going to find out why. And the euro, is it finally ready for collapse, as I've been talking about over the last couple of weeks? And the trading takeout today is how to spot a trend forming and why you need to jump on it as fast as possible. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. It was a really bad day for the Nasdaq yesterday, down almost 2.5%. And really it's driven by, I think, the geopolitical tensions, I guess, out in the Middle East. I think the US starting to get involved in the war, and then there's murmurs of China moving warships. It just creates an environment of feeling a bit of uncertainty that like something could pop off. And of course, there's the yield issue as well. As yields start to tick back up, which they had done yesterday, we see the Nasdaq come off, because when you look at, sorry, let me just change this. When you look at a calculation of effectively what stocks are priced on, a higher yield makes stocks less attractive because you're looking at the risk-free rate of return. What would an investor prefer to do? Would they prefer to take a higher risk for less return with stocks relative to the risk-free rate of return? So the risk-free rate is the yield on a 10-year bond or another government security, because it's deemed that you're always going to get your money back. The US government isn't going to default on your bonds, basically. They're always going to pay you. So that's why they benchmark against that, and that's why the 10-year yield is used in so many models. So it's kind of like a seesaw. If the yield goes up, the price of stocks tends to go down. That's not necessarily been the case because it's been based on relative surprise, I guess. But now we're starting to see, okay, maybe because we're at peak interest rates, there's no more room to go. The Fed are kind of maybe getting a little bit scared. Maybe the data's rolling over a little bit. People are looking at that and thinking, oh gosh, and we can see the peak interest rate sort of phenomenon here. So this is where we're currently priced. And this is where the peak is expected to be priced at. So the peak is expected to be priced at 94.57 and a half, whereas where we are now is 94.67. So there's no hike priced in, basically. The hike's being priced out, so we're at peak interest rates right now. And yes, when that tends to happen, there's no more relative move. So traders are looking at the data now and thinking, oh, we're at the peak. The Fed doesn't think that there's any more space to go because perhaps growth concerns are coming in. They're thinking that maybe stagflation issues might, come into the fray. They're thinking that global PMIs are rolling over, US PMIs are rolling over. So all of these things are coming into the fray now. And when you've got a higher yield, but not necessarily the reason for that yield to be remaining up there in terms of, growth possibly collapsing, then people are going to say, oh God, I need to sell my equities down now because it's deemed more risky. The sort of other side of that, though, is that the only real potential now, and as we can see here, is for cuts to start coming in. And that should be supportive of equities. But when the Fed has to cut, the reason for them cutting tends to outweigh that kind of model of the yield coming down within the model that prices the value of the equity. Because if the Fed is having to cut, it means that unemployment's higher. It means that earnings are lower. It means that, people are earning less. So the initial reason for the cut tends to be bad. So if we start to see now on this curve on the Fed funds futures, if we start to see cuts to get priced in sooner, so in earlier 2024, then equities will sink even lower because the market is deeming the economy to be worsening quite rapidly. So pay attention to that. Watch out for it. And it's pretty much the same story in the euro. The euro dollar tends to follow equities during times like this when things seem a little bit more stressy. What I'd be watching for on the euro, though, is in the short term, this break of this this trend that's formed through October. What we could see is, if people do start to get really super short today, is that tomorrow we might see a reversal if we break through this low. So what we might see is this and a retest and something like that. But again, it's exactly the same reasoning as why equities are selling off. You know, people are getting more risk averse based off of the repricing of, firstly, interest rates, the repricing of the path of interest rates more specifically. And people are looking at perhaps the differential between the Eurozone yields and the US bond yields. US bond yields up higher, more with more velocity, basically, than German yields, than Eurozone yields on aggregate. So you're looking at a higher yield on the US dollar versus a lower yield for your euros. And that is what drives currency markets. You know, some people say that they don't, but they have no clue what they're talking about, quite frankly. And genuinely, someone has said that even this morning, because the Australian dollar has fallen on a higher CPI number, which is just insane. And so, you know, it's one of those times where the direction of the euro was set, as I was speaking about a couple of weeks ago, even a couple of months ago. This is a 15-year trend line. You know, it's never made a higher high. You can see on every single cycle, it's been exactly the same. And it's no different here. You know, the euro is fundamentally a currency that will require depreciation consistently. Firstly, because of the rate of printing relative to GDP. It's going to devalue the currency versus the dollar. I think the Fed's balance sheet relative to US GDP is about 36%, whereas with the Eurozone, it's about 75%, I believe, maybe even more. So obviously that's a perfectly fine trade-off to view and make there. You know, it will translate into currency weakness for the euro, strength for the dollar on a relative basis, that is. So the path for the euro is unchanged for me. It's down. If you look at it on a weekly time frame here, which I've got in front of us, you can see from a technical perspective, you know, it's even sort of traded above this range this week. So let's call this 1, 2, 3, 4. So since the end of September, it's had a range here. And what you tend to find is that when a range is made like that and it trades above and probably closes below this week, you tend to see some continuation. So what we could possibly argue is we're looking at 1.02 in the nearer term, so maybe in the next week or two, as a target. And the other key thing as well is that buyers jumped in right here. So you can see that as this low was taken, if we note that, we got to think of who might be stuck. So there were some buyers here, jumped in at the start of October, right at the start of October. And these guys might be stuck in a narrative of pre-Israel. So Israel was towards the end of the week. I think it was the 7th or 8th that the market opened and it kicked off. So it was the 9th, yeah. So Israel happened on the 7th and 8th. These guys were buying before that week, so they might have a different thesis. So their stops are likely going to be down here somewhere, all within this gap. So you can say, all right, this is my counterparty here. How do I get them out? How does the market want to affect these guys? Who has the weaker hand? Who's got new information here relative to here? And that would probably be a strong thesis to have, you know, as long as you maintain and keep good risk management, basically. So you're looking at this area, who is stuck effectively. And there's probably quite a few people here based on the new information that we have this week. That is how I look at the chart. I don't look at charts from a perspective of technical analysis in that sense. I look at, okay, at what point did the market react? In which ways do the candles or bars represent a certain reaction? And what new information overrides the information causing someone to buy or sell previously? And are they a weaker or strong hand now? So as I've just described with the euro example, it's very important to identify a trend and the reasons as to why a trend might have kicked off. But equally, it's important to identify who is stuck, because those people who are stuck in a trade can tend to cause an ignition or catalyst for quick movements through, which really create that trend-like behavior. For example, in the euro, I think that there's quite a few people stuck buying before Israel-Palestine kicked off, which is older information now. You know, there's new information with regards to the economy. There's new information with regards to how the conflict is going, and there's new information with regards to positioning. For example, you know, Bill Ackman, as an example, has closed his bonds short. So there's big things that have changed since the start of the month, and it's your job as a trader to identify these changes and identify who might be stuck and where the catalyst for a trend continuing might be. But the overriding thing is to note down what you think is the key driver of the trend and see whether those components are affected over time, because that is the only way that you'll be able to manage your risk and manage the trade throughout its life cycle.